Hello and welcome back to Balance Sheet Investing. The trade desk stock just crashed 39% after its latest earnings. That's huge. So today we are going to unpack what really happened, why investors are suddenly worried, and what might happen next. Before we begin, a quick note. This is not financial advice. I'm just sharing my own research and opinions. Please do your own homework before making any investment decisions. So let's jump in. Let's start with what exactly the trade desk does. Imagine that you're watching Hulu, scrolling on TikTok, or playing a game on your cell phone, and an ad pops up, let's say for the sneakers that you've been thinking about buying, or a vacation spot that you have been researching for the last 1 week. Now, that's not random. Behind the scenes, companies like the trade desk are making sure the right ad reaches the right person at the right time. Now, from the advertiser side, let's say you own the sneaker brand. Now, instead of making deals with each and every website and streaming service one at a time, you go to the trade desk. Their platform is like a super fast marketplace that lets advertisers bid for ad space all over the internet in milliseconds. The trade desk finds your ideal customers and shows them your ad wherever they are, be it on streaming TV, be it on websites, podcasts, or an app. And they take a small fee from every dollar that advertisers spend on their platform. The more ad money flows through, the more they earn. Now let's take a look at their Q2 results. Revenues went from about 584 million all the way to 694 million. That's about a 19% increase. But when you look at the expenses, platform expenses went from 110 million to 150 million dollars. That's almost a 37-38% increase. Sales and marketing expenses went from about 133 to 161. That's again close to 30% increase. So they are clearly having to spend more money in sales and marketing in order to generate that increase in revenue. Similarly, technology and development cost went up from 110 to 134 million dollars. The general admin cost came down slightly, but overall the operating expenses went from about 489 million dollars to 577 million dollars. So clearly, margins have been under a bit of pressure this quarter. Now let's take a look at the balance sheet. They have cash and cash equivalent of about 896 million and short-term investments of about 790 million. Consider accounts receivables of about 3.2 billion, and then you get total current assets of a little over $5 billion. If you come to the liability side, then you see that they don't have any major liabilities. So this is a cash-rich company, and the balance sheet looks to be in a good shape. Now let's take a look at the cash flow statement. So they had a net income of about $140 million. Add back depreciation, stock-based compensation, and working capital, and you get about $456 million in the cash provided by operating activities. That is a good jump compared to last year. Overall, I think this company is still generating good cash flows. What's more important here is that if you actually scroll down to the financing activities, you'll see that in the last 6 months, the company has purchased stock worth $647 million. Now, if you take a look at the stock price in the last 6 months, it has been lower, and that's a good thing that the company is purchasing stock when the stock has fallen off of a cliff. So the core numbers look fine. But growth is slowing a bit, and in today's market, slowing can scare investors, especially when there's a giant competitor on the horizon. And that competitor is Amazon. Amazon's ad business grew 23% in Q2 to over $15.7 billion in revenue. And they're no longer just selling ads on Amazon.com or Prime Video. They're now letting advertisers buy ad space across the open internet, which is the trade desk's turf. Here's why that is a big concern for the trade desk. Amazon charges much lower fees, about 1% compared to the trade desk's 7 to 15%. Amazon has the best shopping data in the world. They know exactly what people are buying, which means that the ads can be way more targeted. They've grabbed premium ad spots on Hulu, Disney Plus, and even NFL games on Prime Video. Some big advertisers have already started moving tens of billions in ad budgets from the trade desk to Amazon, and that's enough to make Wall Street nervous. And on top of that, the CFO suddenly quit. Based on that, the analysts have started downgrading the stock, and as a result, you see this 39% stock plunge. But it's not all doom and gloom. Trade Desk has some strong growth engines. Kokai is their AI brain that optimizes ads automatically, and it's been gaining traction. Moreover, they do have a scope for a huge expansion internationally, right? There are huge markets like Europe, Asia, Latin America that are still opening up to the digital ad spending. Then there's connected TV, right? Ads on streaming services like Hulu, like Roku, where Trade Desk is already strong. Plus, they're independent, meaning that they're not tied to one company's ecosystem like Amazon is. For some brands, that neutrality matters a lot. Now, let's talk about the future. The global programmatic ad market is worth over $200 billion and it is growing fast. If the trade desk can keep innovating, grow internationally, and hold on to advertisers in connected TV, the stock could recover. Remember, they already have over 95% customer retention rate. But if Amazon keeps taking market share, it could be a rough road. So here's how I see it. Let's try and see how that works in terms of numbers. Let's do a valuation analysis in terms of the worst case, the base case, and then the bull case. Let's look at the bear case first. Let's say that Amazon takes market share and the trade desk grows at about 10%. In that case, the potential revenues in 2030 would be about 4.5 billion. Assuming a free cash flow margin of 28%, you get free cash flows of about $1.2 billion. Applying a 25 times multiple, and you get a potential market cap of 32 billion, which is about a 25% gain from today's market cap. Now, taking a look at the base case scenario, here we assume that the trade desk continues to grow in the mid-teens. Let's assume 17% growth over the next 5 years. In this case, the potential revenues in 2030 would be about $5.8 billion. Assuming a free cash flow margin of 28%, we get free cash flows of about $1.63 billion. Applying a 30 times multiple, we get a potential market cap of $49 billion. That's about a 2x from the current market cap. Now let's consider the bull case. Here we are assuming that the trade desk continues to lead this market and grows at about 25%. In this case, the free cash flows would be about $2.3 billion. Applying a 35 times multiple, we get a potential market cap of $80 billion. That's over 300% returns from the current price. Now, of course, these are my assumptions. You could always change the numbers and figures depending on what your perspective is about the trade desk. If you found this breakdown helpful, please do hit the like and subscribe button and do drop in a comment. Do you think the trade desk can bounce back or is Amazon unstoppable? Thanks for watching and I'll see you in the next one.